Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. Along with other labels, investing in Tesla can also be described as an asymmetric investment. An asymmetric investment is one where the potential outcome outweighs the probability. For example, imagine if I said you could roll a dice, and if you get a 6, then you receive 20 times your money. That's a 1 in 6 chance of getting 20 times your money. That's an amazing return for the odds. Would you bet your entire life savings on that? No, that would not be smart, as you still have a 5 in 6 chance of losing. In fact, you wouldn't want to put down anything you couldn't afford to lose on such a bet. But what if I said to you, we can play this game as long as you like, and keep rolling dice with the same odds? Well, that's different. Eventually the chances of 6s coming up will level out to 1 in 6. And this is how asymmetric investments work. You likely lose a lot of the time, but when you win, then you win big. More than enough to cover your losses. So let's review how Tesla is an asymmetric investment. There are enough Tesla investors out there spouting claims that Tesla will hit over $10,000 a share, rendering it the most valuable company in history, which is around 14 times return going by the stock price at the time of this recording. Okay, granted, most people do give this a 9-year time or so for the price target to be achieved, with 2030 being the favoured year mentioned, so perhaps we should discount that figure to give us a net present value. We'll discount it based on the opportunity cost of having your stock invested in the S&P index fund, and use the average return of a nominal 10%. Okay, a strange way to discount, but this is an economics channel, and what's an economics video without mentioning opportunity cost? What's the cinematic element of economics? Nope, it's not supply and demand. It's one word: scarcity. This is why we have economics, because we live in a scarce world. If we were in the Garden of Eden, then economics would not exist. As what's the opposite of scarcity? Abundance. We do not have abundance, so instead we must economize in an economy. The word actually derived from Greek, meaning to manage your household. Therefore, due to scarcity, every dollar spent has an opportunity cost of a dollar spent elsewhere. Assigning prices on items is how we manage opportunity cost with supply and demand to reach the market clearance price. This is why communist Russia used to have long bread lines. The prices didn't match the market clearance price. Anyway, that gives us a net present value of 4,240. Wow, seems significantly lower now, doesn't it? And instantly more believable, which would imply a 6 times better return than an S&P index fund. So, in reality, this is the figure we're looking at targeting. Of course, there are plenty of models out there that show this figure could be significantly larger before 2030. But these two numbers, $10,000 by 2030, seem to be used with a lot of rhetoric. Therefore, what chance do we assign Tesla to reach this? If Tesla are averaging $100 net profit per kilowatt-hour battery, which is likely possible, for example, if Tesla vehicles have an average selling price of $33,000 with 30% margin, then that's $10,000 gross profit. If the vehicle has an average of 50 kilowatt-hour battery, then that would be $200 gross margin per battery. If we just half that to get net profit, we arrive at $100. Bear in mind, I just did this off the top of my head without a full econometrics model, as I'm using these numbers for indicative purposes only. Yes, I'm somewhat picking these numbers out of thin air almost, as we are talking about 2030, but they shouldn't be too far off. Okay, a PE ratio of 20, I can't see anyone arguing too strong against that either way, meaning Tesla need to generate $50 billion net profit a year, and if each kilowatt hour of battery produces $100, then we need 500 gigawatt hours of battery. Okay, yes, we do have other products too, such as solar, HVAC, insurance, and maybe domesticated robots. But the core of the business, as far as we can tell, is the batteries, and everything stems from them, hence why I will continually say how important they are. And to keep things even more conservatively simple, we won't add the potential values of robotaxis, FSD, or autobidder. Okay, there you go, we arrived at the numbers we need for this analysis. If Tesla can secure as many as 500 gigawatt hours of batteries by 2030, it will give you a real rate. Well, I say real, but we're discounting by a crazy 10% using opportunity costs of an S&P index fund compared to actual inflation rates. But so be it. I like to act on a conservative side, but these numbers still get so crazy I can't help it. You're following the math the whole way with me. You aren't witnessing me make up any numbers. I wouldn't do that, particularly as there is a chance I might have some influence over your financial life. That would be highly unethical. I want to build my reputation on delivering accurate numbers, not big numbers. Okay, so a real return of 6 times your money. Not bad. exceptional even. So it's showing signs of an asymmetric investment. But what odds are we going to place on Tesla reaching 500 gigawatt hours a year? That's a lot of batteries. Well, they still have 9 more years to gather that many. And where are Tesla currently? Well, with about 900,000 vehicles averaging perhaps 60 kilowatt hours a vehicle this year, well, that's only 54 gigawatt hours. And then add energy. Well, energy's tiny at under 100 megawatt hours a quarter still, but let's round it up to 60 gigawatt hours for this year. Elon said on Q2 that he expects to double the number of batteries he gets from his suppliers next year, taking us to 120 gigawatt hours. We also expect Tesla to hit about 30 gigawatt hours in-house next year, and at a run rate of 100 gigawatt hours at the beginning of 2023. If at a run rate by the start of the year, then you might expect 2023 total to be about 150 gigawatt hours in-house. Although I hope once this process is sorted, it's more of a rinse and repeat job from there, which is where I see the biggest opportunity in the company. Either way, there's a good chance that Tesla have scaled to something like 300 gigawatt hours of battery supply by 2023. Well, that leaves 7 more years to hit 200 gigawatt hours more. What odds would you place on that? Pretty damn likely, I would say. But for numbers' sake, let's place 50% chance Tesla can achieve at least 500 gigawatt hours by 2030. But back to our dice analogy. Well, in that scenario, if you scored 1 to 5, then you lost all your money. But with a Tesla dice, it's a bit different. Well, the Tesla dice pays different amounts with different numbers. For example, you might also want to place a 10% chance they hit 3 terawatt hours by 2032, which could then give 30 times return. This would further add to the expected probable outcome of your return. Of course, you might think each kilowatt hour battery is only worth $50. Then you'd have to double all the battery objectives and thus reduce the odds. Right, sure, I can hear you. It looks like I need to do a proper econometrics model to calculate what each battery might be worth in 2030. On the other hand, I gave this a savage 10% discount. If I'd stuck with the inflationary rate, then the real return is about double, with a real price of $8,000 discounted at 2.5% a year, compared to $4,240. But we're all capable of investing in an index fund, which is why I used a net present value in lieu of just using real terms. If you think any of my numbers look wrong, then let me know in the comments, but I still can't get my head around why this stock price is so low. But I thought the same when it was $250 pre-split price. What was I missing, I'd ask myself. What have I gotten wrong? The market is highly irrational. This is how Warren Buffett made so much money. He would wait for the market and or a specific stock to just have an absolute fit of insanity and buy it all up. Asymmetric, contrarian investing. I do enjoy doing these numbers, and it's always interesting to see what comes out on the other side. I'm going through it all with you at the same time while I'm scripting. I don't start with any numbers I'm trying to aim for and then reverse engineer the equations. I simply work them out with you and am equally surprised sometimes where we get to. But stocks do not follow these sort of numbers. But stock prices do not follow these sorts of numbers. In case you hadn't realized already, they follow emotions, a madness of crowds. Sometimes the crowds are greedy, other times they're fearful. Ignore the stock price, it's a distraction. Instead, concentrate on the company itself and how it's growing. I mean, if you ran your own company, which I know many of you do, and you knew how much more growth and potential your company has, and then you have someone shouting out valuations for your company, and then if they suddenly shout a really low price, would you then be more likely to sell? Of course not. So why is investing any different? Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.